All right. I hope everyone is doing well, and thank you so much for joining here today. The title of today's talk is Plan and Prosper because uh, Prosper is going to be really the theme the next 3 years. 2022 is going to be a very good year. 2023, a little bit softer, but still above today's level of activity. And then 2024, we'll see an upturn in the economy again. And so I hope that you leave all today excited about the future. You should be excited about the future, but also ready to put plans in place. And we'll be talking throughout this webinar about some things that you can do in your business to get ready for that rise that's going to be coming in the macroeconomy. As always, I love to take questions throughout. So if you have a question, please feel free to put it in the chat box or just unmute and ask your question as we go along. And there should be a little bit of time at the end too for a more formalized Q&A. But if you have questions as I'm going through on particular content, just please feel free to ask, and I'll do my best to monitor the chat. So let's get started with a look at the US economy. And when we look at the US economy, we always look at the leading indicators here at ITR. That's how we make sure that we're forecasting objectively, not just based on what we want the economy to do, but actually what is the most probable thing to do. And when we look at our dashboard of a dozen key leading indicators, they tell a pretty consistent story. And that story is that there will be slowing growth here in the economy in 2022. So 11 out of the 12 are in decline. Decline is not necessarily a four-letter word. Decline is going to mean that we'll have just some lower rates of macroeconomic rise. But it does mean that that's going to allow the supply chain to catch back up a little bit. It's also going to mean that we'll see inflationary pressures ease as the year progresses. And so less inflationary pressures, fewer supply chain problems, that's going to be welcome news. And the year-over-year growth rate for 2022 for both MTI and for business-to-business spending, industrial production, and the like is going to be healthy. So I want you to be excited about this. I know it says decline, but there's going to be a lot of good things that happen here in 2022, and we want you to be ready for them. When we look at our forecast for US real GDP, it's off in the teal bars there on the right-hand side of your screen. You can see that there's a really uninterrupted rise through the next 3 years. So I just want you to compare, though, the slope of the rise that we'll be having. So if you look here at the pandemic, you can see this 2-quarter fall off. That was the shutdowns from the initial COVID period. And then we've had this incredibly strong surge back in real GDP in late 2020 into 2021. We're going to see that rate of rise slow a bit here into about the middle of 2023. You can see it almost moves flat at the very middle of 2023 before things pick back up. So definitely overall growth theme. The real potential, if there was one, for a quarter or two of decline would be in 2023, not this year. The reason for that is, even though that we have high inflation, consumers have a ton of spending power that they can tap into. Incomes are up. Debt levels are very, very low. A lot of people spent a lot of the pandemic stashing away their paychecks, paying down bad debts. When you look at credit card debt, for example, it's just easing off of record lows in terms of the percentage relative to income. And so a really positive sign that the consumer is ready to drive the economy higher. And even though the MTI operates in a lot of industrial markets, keep in mind that consumer activity does trickle down to those industrial markets. The correlation actually is pretty strong between consumer behavior and some of those industrial market trends. So that's really good news. The other good piece of news is that businesses are in a strong financial position as well. We've had a few bankruptcies of late, very low loan delinquencies, very high levels of corporate cash, and strong corporate profitability. And so all of that's to say that businesses are going to be out there spending more money as well. And so when you see businesses doing well and you see consumers doing well and poised to bring more gains to the economy, you can be excited for the future. So real GDP growth through at least 2024. 2023 will be a softer year than either 2022 or 2024. So that is just something that you should be factoring into your planning. Retail sales, let's take a look at that because again, the US economy is a consumer-driven economy. In the top line, you can see in green what we call our 12 over 12 rate of change. That's at 19.3% right now. That's saying that the most recent 12 months of retail sales are up 19.3% from those same 12 months a year earlier. That is a phenomenal result. And you can see relative to the prior history, retail sales likes to grow at about 5%, 4%, 6%, 3%, somewhere along there. 19.3%, I always call it an adjust the chart moment because the scale of the chart has to be widened so to accommodate this really incredible growth that we've seen in consumer spending in 2021. Why does that matter? Again, that spending tends to trickle down to industrial markets as time goes on, and so benefits you in a number of ways. The caution flag is out just a little bit though. When you look at the 3 over 12 rate of change, that's the gray line in the top panel, it's at 17% and that rate of change is declining. So on a quarterly basis, the most recent 3 months are up 17% relative to the same 3 months a year earlier. So whenever we see the quarters start coming in a little bit softer than the years, which is the case for retail sales, that's a sign that there's going to be slowing growth in the future. And that's indeed what we are expecting for 2022. We're not going to be able to keep up this 19.3% clip for retail spending in 2022. And that makes perfect sense because the stimulus effect is beginning to fade. The Federal Reserve is looking to raise interest rates. We've had inflation start to nick a bit at the consumer. And so the retail sales just won't be able to rise at the same rate that they have. But overall, the consumer is in a really healthy position. It'll still be growth, just slowing growth. Here's how we know that that consumer is in such a strong position. What we do with this blue line here is we take a look at household debt service payments. So how much people have to pay out on a monthly basis to service whatever debts they have, maybe their mortgage, maybe their car payments, credit card debt, what have you. And we look at that as a percentage of overall disposable personal income. And so you actually want to see a low number, and 9.2% is a very low number. The debt load is not too high on consumers, is all that's saying. And I just want you to compare and contrast that with some points in history. If you look before the 01-02 recession here, we were at a much higher percentage, something more like 12%. Right before the Great Recession, we really got elevated, over 13% at the peak just before the Great Recession unfolded. Those were unsustainable levels of debt for the consumer. Right now, we're in a much lower position. And I just want to show one other example of a time when we were sort of coming off of a trough was in the sort of early to mid 90s here. Well, that was a tremendous period after those early to mid 90s. Mid 90s into the latter 90s was a wonderful time for the US economy. And part of that had to do significant part of that had to do with the fact that the consumer could take on more debt. And indeed, that's what we expect for the next few years. So that's a good thing that they're going to be able to handle these debt payments. There's nothing unsustainable right now about those debt loads. That could change in the future. We're certainly going to be keeping an eye on this as we see these higher inflationary figures, consumers taking out more debt. Are they going to be able to hold things up? But right now for 2022, the answer is very clearly yes, the consumer is going to be able to take on more debt as well as dip into those savings to fund economic growth. So let's take a quick switch over to business side. So the blue line is US non-defense capital goods new orders taking out aircraft. So that's really our metric for business to business spending. These are capital goods, things like machinery and the like. And what we're comparing it to is a leading indicator, and that's the US Business Confidence Index. That's in green. It's a 1/12 rate of change. So all that means is we're looking at the most recent month of business confidence compared to the same month 12 months earlier. And what we do is we shift the green line forward by 12 months. Why do we do that? That's to align the cyclical peaks and troughs. So you can see that back in the history, the peaks and troughs in the green and blue lines are aligned once you do that shift forward. So what that's telling us is basically, okay, this is how the blue line, capital goods new orders, is going to perform over the next 12 months. And what it's saying is we're going to see a growth rate peak here in the very near term, and then we will see growth rates fall off progressively from there. Still looking unlikely that we will be seeing any sort of contraction in 2022 here. That's pretty much for certain. For 2023, things get maybe a little bit more interesting because you can see that the business confidence index has started to just tick below the year ago level. So we're certainly going to be watching this trend and what it means for 2023. But for 2022, we know that business to business is going to stay strong. We think in 2023, business to business spending is going to end really more flatten out at the very, very bottom of this cycle, but we think it'll avoid contraction. And part of that is inflationary pressures. Non-defense capital goods new orders are denominated in dollars. And we'll be getting into inflation a little bit later, but that cushion of inflation, prices rising over time, is going to cushion some of that capital goods space. The one thing I did want to bring up, though, that is a potential concern and risk out there that you should certainly be aware of is the potential for cancellations. A lot of firms or entities, whether it's individuals or firms, were putting in multiple orders for really they just wanted one good. And so they were having trouble, of course, getting that good because of the supply chain problems. And so they'd be putting in those orders at multiple different companies. What we're a bit concerned about is on the backside of the business cycle, which the leading indicators are clearly indicating that we'll be in here in 2022, 2023. We could find that some of those orders get canceled. So we wanted to let you know that for two reasons. One, of course, that would sort of inflate the recent data and could deflate the data sort of later, making it look like there's this hole in orders activity. And the other is you want to make sure that your order cancellation policies are in good shape, because if you don't want to get caught on the wrong side of that and think you have all this business out there, this backlog of orders, and find out that it's actually not hard orders. So just something to be aware of, certainly, that we're keeping our eye on here. When you look at capital goods new orders now, this is just zooming in on the data series itself. It's closing rapidly in on $1 trillion in annual spending. So right now we're at $914.5 billion for the 12-month moving total, or 12 MMT. That's the green line on the lower panel of your screen. On the upper panel of your screen, that 12/12 rate of change, year-over-year growth rate, is at 15.0%. But just like retail sales, we have a 3/12 rate of change at 12.1%. So our quarters for capital goods new orders are coming in softer than our years. That's all that means. And that's a clear signal that we're going to be seeing a shift in the business cycle. So put together that prior slide, we have a leading indicator signaling that we'll be on the backside of the business cycle for non-defense capital goods new orders, and clearly the internal data itself suggesting that as well. There's other leading indicators as well that are signaling that capital goods new orders will be on the backside of the business cycle in 2022. So be prepared for some lower growth rates ahead. One of the pitfalls we find is that after this great year that is 2021, sometimes in the business community, there'll be people out there who are saying, well, it's just going to keep going. Times are so great. Can't possibly soften up. And clearly the leading indicators are telling us things will soften up a bit in 2022. That's not all bad news. As I said, it'll allow those supply chain problems to untangle a bit and inflation to come down a bit, but it will mean that lower growth rates are more probable this year. So you definitely want to be factoring that into your planning. When you look at industrial production, I want you to compare and contrast that 5.6% 12/12 rate of change, year-over-year rate of change in the upper panel for industrial production to those double-digit rises that we saw in capital goods and retail sales. That really is the supply chain problem in a nutshell. Right? You have this incredible surge in orders and in retail spending, but in terms of what we can actually produce, it's been a bit harder. That, of course, has to do with labor, it has to do with materials, it has to do with COVID, all of the above. But we are getting closer every day toward more of a balance between supply and demand. And as 2022 progresses, we'll see supply and demand come more into alignment. We've had such incredible surge in demand in 2021, woefully inadequate supply, and just a host of industries, no fault of their own really, but just pandemic related, labor related, materials related. And as we see 2022 progress, we'll continue to see industrial output rise, and we'll see demand taper off a bit. And so that'll help really get things more normal. And I think we can all agree that more normal in many ways is going to be a welcome sight for sore eyes. So just like the other series that I've showed you, the 3/12 rate of change at 4.6% is running below the 12/12 rate of change. So we're quickly approaching a shift in the business cycle for US industrial production. We think it'll be in a slowing growth trend. You can see the forecast bubbles for the growth rate. We expect it to stay above zero and have that proverbial soft landing. So no year-over-year contraction at the bottom of this cycle. That's a function of how strong the consumer is. It's a function of how strong businesses are, as I already mentioned. And it's also a function of how stuffed full backlogs are. And so we know that industrial activity is going to need to continue to rise. By the way, industrial production, in case you were wondering, is about 3/4 manufacturing activity. It's about 15% or so mining, the vast majority of which is oil and gas here in the United States, and it's about 10% utilities. So that's what makes up this industrial production series. The other thing I should note is there's another difference between that 5.6% and those double-digit rises you saw for capital goods and also for retail spending, and that's that this is industrial output. It's in the number of units, right? It's an activity measure. Orders and retail sales were, of course, in dollars. And so inflation isn't factoring in here to US industrial production, where it's factoring into those other series. So inflation, of course, certainly helped with 7.5% consumer price index inflation over the last 12 months and double-digit producer price inflation over the last 12 months. That certainly helped boost that capital goods trend and also the retail sales trend. So just to recap, consumers are in good shape. They have a strong financial health. Businesses, same thing. We love to see both sides of the economy, the consumer side and the business side, in a good spot. And neither consumer debt nor producer debt, business to business debt, is a concern at this time. And so what that really means is as you look to acquisitions or you look to markets, know that balance sheets are in a very good place. It's not at a time when it's very risky out there to be doing those sorts of moves. Margins are high, confidence is high, although beginning to taper off as that business confidence slide showed. But still overall at a high level, it's just starting to ease a bit relative to a year ago. So this is a great time in the business cycle. And as we look forward, one of the major things that you're going to have to contend with is inflation and interest rate pressures. And that means that instead of so much focusing on being able to grow the top line, it's going to be a lot of focus paid to looking at your margins and making sure that you can keep these margins that you've had going on into the future. And that brings us to one of the biggest problems for businesses really across the industrial sector, but beyond the industrial sector too, and that's finding enough people. There is really a shortage of labor out there. And when you look in particular in these areas of the country like Texas, like Florida, like the Carolinas, like the Mountain West, Colorado, Utah, Idaho, where all these people have been moving to, these are growth rates from 2016 to 2020. It's really, really, really hard to find workers. It's hard to find workers across the board, but especially in these places of the country where people are moving. And one trend you'll notice between sort of the southeast pocket there of dark green, very high growth rates, and then also this pocket from Texas up to Washington state, with the exception of New Mexico, there's this real population growth there. Those states tend to have a couple of things in common. One is they tend to be warmer weather states. Idaho, a bit of an exception there. Utah, Colorado, maybe not so much, but tend to have warmer weather, certainly. They tend to be lower tax states, not every single one again, but overall tend to be lower tax, tend to be business friendly, and tend to be the sorts of places where there's some really dynamic areas of the country. When you think of Texas and you think of Dallas, Fort Worth, and Houston, and Austin, and San Antonio. I just got back yesterday from being in Central Florida, Orlando, and Tampa. That area is just a really vibrant area of the country. Atlanta, Nashville, on and on and on. Those parts of the country, highly diversified economies, people are going in to take advantage of the business opportunities, the lower taxes, the warmer weather. Those are places where people have been moving in droves. Of course, we're really, really curious to see how population growth went in 2021. And I'm very curious to see there. But generally speaking, based on what we're seeing in the construction data and some of the other indications, is that if anything, these areas that have already been really, really busy in terms of people moving there, that's increased. In contrast, when you look at the places where population has been leaving, you're looking at places like New York State, Connecticut, Illinois, places that are high tax, cold weather, or you have places that have very undiversified economies, right? Alaska, Wyoming, Louisiana, Mississippi, West Virginia, places where there is not this widely diversified economy. So as you look out to opportunities, think of that, and also be considering where you are in the country as far as geographic location, as it comes to attracting talent, retaining talent, and looking for those business opportunities. So here is a graph of some major sectors showing the pain that we have finding available workers. If you look at the bottom panel, you can see the 12-month moving average of job openings for wholesale trade and for transportation, warehousing, and utilities. This is why we're having such a hard time moving goods around the country, right? Transporting them, warehousing them, distributing them vis-a-vis wholesale trade. It's been really a big challenge. Manufacturing, the 12-month moving average, over 800,000 workers. If you look at it on a monthly basis, it's around 1 million workers that we have, or openings, I should say, not workers, openings that we wish we had workers for. Really a huge problem. The good news is that as we see industrial production, that's in green, and our forecast with the diamonds showing that decelerating growth into about the middle of 2023, and we stack it up relative to quit rates. You've, I'm sure, seen in the news and felt in your business this issue of people changing jobs a lot, quitting their current job. It's a good sign for the health of the labor market in the sense that those workers feel that they can do that, but it's hard on businesses, of course. But the good news is, as we see this slowing growth trend develop, we'll see the quit rate begin to ease a bit. That rate of change will be coming down. So we really have the worst part of the labor shortage ahead of us, and then we'll see a little bit of incremental improvement the deeper we get into 2022 and especially 2023. By the way, this chart also shows us our long-term outlook for US industrial production. You can see that slowing growth trend into the middle of 2023, then things pick up in 2024. 25 is generally a year of slowing growth. The next recession, we think, will be 2026. The reason for that is that's really when these interest rate and inflationary pressures are going to come to bear down, and consumers won't be able to take it anymore. Like I showed you on that earlier slide, the consumer can take it right now and have really low debt levels relative to incomes as a whole. When I'm talking about consumers in aggregate, of course, I know individual consumers can be painful, but overall consumers can handle it right now. But go a few years down the road and that's going to get more problematic. So we really see the risks to the economy start to ratchet up in 2025, 2026. So as you think about the long term, you really are going to want to be thinking about making your money here these next 3-4 years, and then be able to stash some of that away for 2025, especially 2026, as the cycle weakens more appreciably. So here are some ideas for attracting and retaining workers. Of course, competitive pay and competitive bonuses and benefits. Whenever I present this at a speaking group, everyone groans a little bit and says I'm doing what they can. But the good news is that there's all sorts of other things that you can do. When you look at human resources literature, it's rare that workers leave their job just over pay. Now, I'm not saying that there aren't workers that won't just leave you solely over pay, absolutely, and especially the lower wage they are, the more sensitive to pay and bonuses and benefits they tend to be. But especially most workers, and especially higher paid workers, tend to care about things like flexible hours. They tend to really value having a great manager. When people leave, they often cite, by the way, how mediocre or bad their manager was as a reason they walked out the door above and beyond just pay. And when people stay, they often will say, oh man, I just really love working for so-and-so. So that's something we all can do in all of our businesses. Clearly defined career path is really important. All that means is how can you make sure that your place is an attractive place, not just today, but the individual can see themselves in a year, in 2 years, 3 years, 5 years at that same company, at your company, so that they stay. Varied work. Sometimes we just focus on efficiencies and want to put our workers in just the most efficient possible places, but having them rotate through different paths, different tasks can help give them that sort of refreshment that they need to feel good about where they work. Just be transparent and really encourage feedback. The younger generation in particular really values that. And a strong company culture is key. I'll just give you the example. Just before this webinar, I got off an interview with an economist candidate that we were interviewing here for ITR. One of the things we walked him through was our corporate values, our ITR values of how we run the company. What do we care about? We care about our clients first. We care about excellence in forecasting. We care about a commitment to quality reports. We also care about the community, things like that. And work-life balance, we're committed to that as a firm. And so we're trying to disseminate that to clients. And we're finding in other manufacturing clients, construction clients, wholesale trade clients, people who really invest in that good culture, good managers, it can help beyond just pay. So that's some ideas for how to get those scarce workers that are out there. The other problem that's cropped up very clearly in 2021 is pricing pressures. That's been painful for everyone. The really good news is that it's going to be abating bit in 2022. So I love this chart. In the blue line, what you're looking at is the global supply chain pressure index. In blue, that clearly shows what we've seen in the supply chain here. Alan Beaulieu, our president here at ITR, did this research, and I just am really appreciative for him for doing it, because it really illuminates what's been going on. So you can clearly see this spike in the blue line. That's the shutdowns. That's of early to mid 2020. So when supply was essentially zero or very significantly reduced, even though demand was hurting at that time, we still had supply chain problems. Then it got better. Then the stimulus started kicking in. All monetary stimulus, fiscal stimulus, the economy started reopening, and we see this blue line surge again, more supply chain problems. That's really demand related. So it's two distinct issues that we have here: not enough supply and too much demand. As 2022 progresses, like I said, those two things are going to come closer into tandem. And we know that that's going to mean we get a more normal supply chain. We want it to be more around this zero line. That means a more balanced.
Hello. Hey.
So the Purchasing Managers Index is this leading indicator that leads the Supply Chain Pressure Index by about 5 months. And so the fact that this Purchasing Managers Index has been in decline, it's actually a good sign for these supply chain problems renormalizing.
Operators aren't, but the managers meeting is definitely cross-functional, because we have representation from not just quality.
That's not the only problem or only indicator that shows that. If you look also at manufacturing utilization rates, that leading indicator is also moving lower. And so I could have showed you a ton of charts that really show this same story, which is the supply chain will be normalizing. And as the supply chain normalizes, as 2022 progresses, we'll just see some easier sledding ahead. That supply chain normalizing and world industrial production beginning to slow, that's the green line, is going to really help us out on the inflation front. That's the blue line. We're looking here at the CPI, Consumer Price Index, but really you could be looking at the Producer Price Index, or a price index really specifically for MTI and its markets. It wouldn't matter too much. You'd see this same general tendency, which is that we're going to see the rate of change in pricing be moving lower as 2022 progresses. So industrial production leads pricing by about 3 months. And so you can see there in those dots, those blue dots, the upper and lower bounds of our forecast for Consumer Price Index. One thing that's notable, though, is as we see pricing pressures ease a bit, and by pricing pressures, I really mean inflation easing. Prices will still be going up. It's just that the pace of which they'll be going up, that's inflation, will be easing. But you can see that it only gets to about 2% here at the low, at the end of 2023. That'll be the bottom of the pricing cycle, is we'll still be seeing about 2% inflation. We're not used to that. We're used to inflation retrenching to almost zero, right, at the bottom of this cycle in this sort of pre-pandemic, post-Great Recession period. We're going to be more back to like we were in the mid-2000s, in the 1990s, where inflation doesn't go that low. And there's a few drivers for that. One of them is deficit spending. When you look at deficit spending in green relative to the US dollar, typically the more deficit spending you see, the weaker the US dollar. What does that mean? Well, the weaker the US dollar tends to mean that we see more inflation. And so as we have to pay the rest of the world more for our goods that we're importing from overseas, that eventually bleeds into the inflation number. So that's one concern. It's a long-term concern. It doesn't mean that the US dollar is not going to strengthen tomorrow. It could strengthen tomorrow, especially during this period of economic angst that we have as 2022 goes on and we see economic growth slow. But overall, we know that generally as we look out 5 years, 10 years, we're likely to see a dollar, and that weaker dollar is going to mean more inflationary pressures, not less. So there'll be easing inflation, it's just not going to ease that much. So What do we expect? Well, disinflation, that means lower rates of inflation, but still inflation, not deflation, is, is going to occur post the first quarter of 2022. So most of this year, into the first half of 2023, probably into the second half of 2023 as well. Most of 2023 will also be seeing disinflation. Inflation will pick back up in 2024. It's going to help let the Federal Reserve off the hook because demand will be easing and because supply will be ramping up and that supply chain will be normalizing. It's going to mean that they're not going to have to be so aggressive with interest rate hikes. They'll have to raise interest rates, just not a ton. That's a bit more of a future problem. So it is a problem, no, because with all this deficit spending, we are confident a weaker dollar, lack of investment in the oil and gas industry, which makes energy costs rise. Right? All of these factors are contributing to more consistent inflation this decade than last. So we're not just going to go back to what we were like in the 2010s. We're going to have more inflation, and that's going to mean that you're going to have to be prepared for that. You're going to have to be passing along price increases consistently. And so making sure that you have all the competitive advantages possible, all the products that consumers are after, or buyers of your products, that's going to be really key to being able to raise those prices as you need to keep pace with inflation and not let those margins shrink. That's going to be really important. All right, so let's take a turn to the MTI data. For the year, sales were up 8% year over year, and you're in phase B, what we call accelerating growth, where your year over year rise is positive and it's increasing. What you can see though is that the growth rates here in the amber kind of orangey color here, that there'll be a growth rate peak very soon, and we'll see slowing growth for 2022 overall. So growth just at a slower pace. So for 2022, we're calling for 5.4% growth. For 2023, because we expect some of the industrial markets that MTI goes into, we're going to have mild recessions. Others are going to have slowing growth, but on the whole, we think just a really mild pullback is the most likely occurrence for 2023. So just a little over 1% contraction year over year that year. That'll be the worst of these next 3 years. And then we'll have a bounce back in 2024 with 6% growth. So when you look at that on a data trend basis, you can see the rise here and the very mild decline. At the bottom of the mild decline will still be above where we are today before the rise continues. So that's why I said at the very beginning, it's a time to get excited. These next 3 years are going to be good years for the economy because of how strong consumers are, because of how strong businesses are. So make sure that you're planning for that. 2023, if things go really, if we had a black swan event or something in 2023, that's the highest risk of the next 3 years is that year. So I'd be a little more conservative in your thinking for that year. But on the whole, for the next 3 years, it's going to be a good time. When you look at your markets, a number of them have started to transition into phase C. Others are still in phase B, accelerating growth, but pretty soon they'll be in this phase C, slowing growth trend. Construction machinery new orders is one that's already in slowing growth. That's really following the single family housing market, which is cooling. New home sales were down. But we know that there's a lot of demand in that market as we have very, very, very low homeowner vacancy rates, very, very low inventories. Interest rates are still very low, consumer very strong, as I've been saying throughout this presentation. So there's nothing wrong with the inherent demand for housing, but we have all these labor challenges and material shortages that are making it hard to produce those homes. So that's kind of the softer side of the construction machinery market. Over the next couple of years will be the single family housing side. And in contrast to that, non-residential construction is really just starting to get started. Non-residential construction tends to lag the economy through the business cycle. And so this really strong economy that we've had in 2021 is actually going to be a boon to non-residential construction and construction machinery new orders in 2022, 2023 as the infrastructure project starts kicking in. That'll help some of those markets for construction machinery new orders. And so as we look off to the future, we really expect some overall flat to mild growth here in 2022 and in 2023, but it'll be a mixed market. There'll be, as the single family housing side softens, the non-residential side will be coming up. So know that that's the case. And then by 2024, we'll see both parts of the market doing a bit better, probably single family a bit better than the non-residential side, and we'll get a nicer growth rate. So overall, construction machinery new orders a bit softer these next couple of years than certainly the really robust rise we've seen this year, this past year in 2021, but overall a generally higher level of spending than we've certainly seen in the past here pre-pandemic. So when you look at North America light vehicle production, this is one of the very few markets that never has actually recovered, made any meaningful progress in recovery. And when you look at the data trend chart since the pandemic, and that of course has to do with all of these supply chain issues, in particular semiconductor chips. So what we're expecting there is that we'll reach a near-term low, and then we're going to be crawling out of this hole that we've been in for production as that supply chain normalizes. But it's going to take time. Certainly 2023 will be a better year than 2022 for that. And 2024, maybe some softer growth, but we'll finally be starting to get back to more of that 16 million vehicles that we've been more accustomed to seeing pre-pandemic for a number of years. So demand very strong here. That's what's supporting all those sky high used car and new car prices, is how strong demand is. That's not the question. The question is, how do we get the vehicles out? Supply chain improvement will help there. When we look at the heavy truck market, we actually raised this forecast. We had thought that it was going to have more of this double dip movement like automotive had because of the supply chain issues. But heavy trucks have really been able to shrug that off. And so overall, what we're expecting for the next 3 years is this growth trend. 2022 and 2023, more like single-digit growth than the double-digit growth we've had here because of just how strong the initial recovery has been. But overall, this is going to be a market that's on the up. So we definitely need more trucks to move products around the country. That is an acute shortage in this economy. And so heavy truck has a good future ahead. Oil and gas extraction has been suffering. When you look at that 12-month moving average, it's really sluggish, still well below pre-pandemic levels, but it's just about to enter phase B. And when you look at oil around $90 a barrel, that is well above the cost of extraction. And so there's going to be this increased incentive to do this drilling activity, and as well as pump from existing wells. We'll be seeing that market moving higher over the coming years. So that is probably one of the stronger markets, even though it's been one of the weaker markets these last couple of years. That's now going to shift, and it'll be one of your stronger markets in the future. When you look at medical equipment, it's been pulling out of the pandemic downturn quite nicely. We'll generally continue to do so, but for some little dips and fluctuations in there. It's about to enter into a slowing growth trend, but overall, we see good things ahead for this market. When you look at medical care expenditures, they're up, which is good news for medical equipment manufacturing as people resume their normal medical care. And unfortunately for the human side of it, for humanity, is people had to put off a lot of those elective procedures, regular healthcare maintenance. And we're going to be playing catch up these next few years to those health problems. So unfortunate for individuals, but as far as this market, it's going to mean that it'll help them catch back up and recover from the pandemic. So some good news there for the manufacturing side. Civilian aircraft equipment production, this will be up 16.0% 0% year over year right now. This is going to be continuing to climb out of its hole, but it's going to take a long, long time, and we're not going to get back to where we were, pre 2016, 2015, 2014 in the next 3 years. It's just, we're too far. We have too much ground to recover. But as you see travel picking back up and you see activity beginning to normalize a bit, that's good news, but we're still below where we were. Business travel in particular has not come back. And so that market is going to be a recovery market, but it's going to be a slow recovery. When you look at electronics, that's already in phase C, slowing growth. Growth rate already beginning to move lower. We really had that surge of computers and electronics investments as we went remote. That's going to be, of course, dissipating as we normalize our activity a bit. Inflation will help cushion this from having a hard landing, right, a below zero recessionary type movement. So we'll stay out of recession in this market. So that's good news, but we'll see some lower growth rates than we've been accustomed to in the very strong last year or two. 2024 will pick back up again. So overall, this is a good market. One thing in particular is with labor so expensive, any sort of efficiency measures, and computer and electronics new orders tends to benefit from those efficiency improvements. That will be a driver of this data trend moving higher over the next 3 years. So most markets are going to see deceleration for much of 2022, 2023. A few of them are going to have mild recessions. Others are just going to have a soft landing, like computers and electronics, oil and gas. Those will avoid recession. So on the whole, that means 2023 is going to be the softest in the next 3 years, but no real prolonged recession is likely unless we get some sort of economic shock at just the wrong time in this cycle. Some shifting is going to be occurring, though. When you think about oil and gas being one of the weaker markets of 2020, 2021, now that's going to be shifting to where oil and gas production is really ramping up in 2022, 2023. So your marching orders for the next few years, as we see it, would be really focusing on your efficiencies. In this more inflationary world that we're in, with higher interest rates coming, you're going to need to preserve your margins. And so being more efficient is a must. Considering new markets will be important. You want to get ready between now and that next macroeconomic recession in 2026 so that when that hits, you're as cushioned as possible. So overall, just to remember, most of 2022 and part of 2023 will be slowing growth. You will want to be considering, because I know not every member has the same exact exposure to heavy truck as construction machinery as oil and gas, what those outlooks are and what they mean for you. Some of them, again, have mild recessions. Other, you're just going to have slowing growth. Pricing pressures are going to ease, supply chain is going to be normalizing, but labor is going to continue to be an issue, and we will see inflation be more persistent. So just an example for some commodities, we're at about $90 barrel oil right now. We're not going to go back to $30 barrel, $40 barrel oil at the bottom of the business cycle in 2023. It's going to be more like $70 a barrel. We're not going to go back from $4 copper to $2 copper in 2023. It's going to be elevated. So those pricing pressures are going to stay up there. The rate of rise will be coming down, but the prices themselves are going to remain elevated, and so you'll have to take that into account. So as you look out, what can you do in your organization? Well, make sure you don't play the blame game when growth rates come in a little bit softer for 2022. You just have to adapt your mindset to the fact that it's not going to be like 2021 where any kind of business, almost all kinds of businesses, it was who can get it to me the fastest. It's going to start to be more about price. It'll start to be more about value. It'll be more about how does this product fit my need. Consumers will be a little bit more patient than they have been. And so depending on whether your markets are headed for a recession or not, you want to be either more cash conscious or less, depending on that evaluation. But overall, these phase C management objectives are going to be the most germane to you in this cycle. So as we look out for the next 5 years, inflation, labor shortages, higher interest rates are going to be here to stick. So really being committed to preserving those margins is going to require that you are in a really good place as a company. And one of the ways that you can get in that good place is investing in efficiencies, whether it's automation, whether it's new facility that you need or more space that you need. Keep in mind that interest rates are likely to be rising over the next few years and indeed this decade as a whole. And so locking in those long-term fixed rates right now is a really good idea. Like I said, 2025 and especially 2026, we start getting more concerned about the health of the economy. So you want to be making your money now over these next few years and getting ready for that next recession, not retrenching right now, because right now consumers in a very good spot and businesses are in a good spot too overall.